Today, we are talking about concentrated stock. So that's when you have one stock or very limited amount of stock holdings that make up a large percentage of your portfolio. So we're going to talk through what this typically looks like, how families often feel about these situations, and we'll finish with how we think about them with helpful data for perspective to keep us grounded. For our next episode, as a little teaser, we'll discuss our approach to managing these concentrated stock positions, and we'll talk through why we don't use certain strategies. So stay tuned for that one. So what defines a concentrated stock position?
Yeah, I think one helpful rule of thumb that we use as a starting point is if you have one stock or one position in a stock that makes up greater than 10% of your overall portfolio, that sends up the caution flag for us, or kind of the yellow light goes off of, okay, we need to look at this and think about how this got here, why it's here, and whether this is something we should keep or not. But that's kind of the one starting point we found helpful.
When it comes down to it, whether it's a certain percentage of your portfolio, it's really what position is going to put your financial life in jeopardy. So it's not necessarily a hard and fast rule is what we're trying to say. 10% is probably when we're starting to, it raises the yellow flag and we're taking a harder look at it. But it's really any position that's going to put your financial life at risk. So whatever that might be. And sometimes you can see this played out where maybe you have greater than 10% in a holding, but due to other income streams or different types of however your portfolio is made up, it's actually not putting your lifestyle at risk. Maybe you're spending a lower amount, so you're okay maybe even having more concentration. Again, the 10% is a starting point, but it's whatever puts your portfolio at risk.
Yeah. And most times, Stephen, you and I have seen these situations are from employees who have worked at a company for a long time, and that company's stock has done phenomenally well. But other situations we've come across where somebody gets an inheritance from an ancestor in a big single stock holding that got passed down, or other situations, maybe someone worked at a startup from an early point and got some stock that ended up doing really well. Because it's unlikely that people go out and buy something with 10+% of their portfolio. So usually these are situations that happen through good fortune with appreciation or, inheritances or things like that. But those are the types of situations you and I have seen where this is a factor.
Yep. So if you're working for a company, either a startup or a company that's publicly traded, and they've granted you RSUs, restricted stock units, as part of your compensation, that's typically where we see that accumulates, and over time you end up with a large holding. Like Matt said, an inheritance. Maybe your grandpa bought Apple stock way back in the day and has held it for a long time, and maybe has gifted it to you or something like that. So those types of situations where we see it come up. All right. So how do investors typically think about concentrated positions? I think this kind of gets a little interesting if we can jump into the psychology of this a little bit.
Yeah, I think another example is, or another way these situations arise is somebody buys a stock. Hypothetically, let's say they bought NVIDIA in 2022, right before ChatGPT came out, and NVIDIA stock has done so well. It's now a huge portion of their portfolio. Well, the dynamic that's at play in situations like that and other situations with concentrated stock is really the fear of regret, where someone has owned this stock or got this stock that has done so well over such a long period of time. And what they're really afraid of doing is selling it, paying taxes, and missing out on even more upside from here. So as a starting point, the fear of missing out on more upside by selling and diversifying some today is usually one of the biggest hurdles we hit with clients and prospects in these situations.
There's lots of different psychological, they're called biases, and we'll run through a couple of them here in a second. But it's really the emotional attachment that we have to this company or stock or story that comes along with the company, whether it's a family story, a family holding, legacy, that sort of thing, or just it's been a great company and you want to stay on the bandwagon. So it's usually the emotional attachment that we have to it, which can actually be dangerous. So a couple of those behavioral biases that we'll run through, it's just good to be aware of these. And once when we say them, They kind of have an academic name, but once when we say them and start talking about them, you'll go like, "Oh yeah, that's I've experienced that before," because we all have it. We're not trying to say that these are bad, but I think just making you aware of them is what will help us out in the long run. So one of them would be the endowment effect. So think of that as we as humans, like, we highly value things that we already own. It's very hard for us to give stuff away that is ours. So think of, your kids or grandkids. They don't want to share their stuffed animal with their cousin or with their sibling or something like that. You can also go as far as saying like, hey, as adults, when you're having a garage sale, maybe your spouse or you are the one pulling items off the shelf to bring back into the house to not sell because it's yours. You don't want to sell it. So that's the endowment effect. And that can come into play with a concentrated position.
Yeah, a couple others that we'll see oftentimes, Stephen, whether people realize it or not, is overconfidence, where someone has seen a positive outcome from this stock or this holding for such a long period of time that they expect it to continue. And this can be really hard to disentangle when it's an employee who still works at the company. So someone who's working on the product at the company or on the team at the company that's driven so much of the value over time. It's really hard for them to see a scenario where all of a sudden something changes and the company's fortunes take a turn for the worse because they're, on the front lines. They're there, they're seeing it. They've seen it happen for so long. They expect the same thing to continue, but really a lot of times that can play out with overconfidence and leading into someone not wanting to do what's really optimal.
Yeah, it's a hard thing, especially when you work for the company. You can say, well, I have the inside track. I know exactly, or you believe you know what's going to come and that the company's going to do really well. But at least history's shown, and we've experienced ourselves, that that's not always how it plays out. Sometimes the market can be a cruel thing, even though from your perspective, the company's doing really well and hitting its numbers and whatever. But the market, for whatever reason, cannot value that. So it's not so much about what you think; it's what the market thinks, and that's going to determine how your stock performs. Another one I think is important in this area is the bias of loyalty. So it's a tendency to overvalue what's known. We came across this with a client that inherited stock from their parents, and if they were to sell it, then to them that feels like selling a piece of their parent who is now passed away and no longer with us. So that is a very difficult and emotional tie to a certain company and holding that is very hard to detach from.
Yeah. And the last one I'll touch on, Stephen, is anchoring bias, which is so prevalent because anything that's happened in the recent past or kind of where the stock price is today is such a strong reference point that our brains latch onto of thinking, okay, well, this is where it is. And a lot of times we can be tempted to thinking, okay, well, maybe just a little bit more. Or if it's gone down, if the stock's off the recent high by a certain amount, we can think, okay, well, it was back up at that recent high, so we'll just wait for it to get back there and then we'll sell it. And a lot of times that can just be a really bad decision. So we need to try and help people think through how much of this stock they should own in an optimal portfolio rather than just where the stock has been or where it is and where we think it should be, because a lot of times that's something really difficult to determine.
So how do we at Birchwood think about concentrated stock positions? And because it comes up now frequently, we've had to dive in pretty deep as to the reasoning. If we are going to hold something or if we are going to sell something, what is our reasoning behind that? We want to share that with you. We've tried to gather as much data as we can about these positions and kind of trying to balance between the risk and reward of holding those versus selling those.
Yeah, I think the key principle at play here is the idea of diversification, which is something that's been studied by academics and applied by professionals in the finance field since the 1950s. And the key point of diversification is that in an efficient market, which we believe stock markets are in a broad sense, where it's really hard to pick stocks and beat the market, as lots of data shows, in efficient markets, owning what's called idiosyncratic risk, where you have one stock in your portfolio and there's a number of things that can go wrong for that stock that won't necessarily go wrong for the market overall. So you don't really get paid over time by holding single stock risk, such that your diversification benefit, which is risk and volatility of your portfolio going down as you move from one stock to a lot more than one stock, moving to something like the S&P 500 or the Russell 1000 or 3000, where you're adding hundreds of stocks to your portfolio, you can still achieve really strong long-term returns. I think the US stock market's up 10% per year for the past 100 years. So really good long-term returns in a very diversified portfolio, but the volatility goes way down and the odds of, failure or bankruptcy for the entire economy and the entire market is significantly lower than the odds of any individual stock going bankrupt or even just dramatically underperforming the market over any multi-decade period of time. So our thinking is diversification, which is often called the free lunch of investing, provides amazing balance of risk and reward because you would maintain really strong upside in your portfolio without a lot of the risk. And two more points on diversification are how, number one, there's a concept of volatility drag, where if you have any individual holding or position that goes down 50%, so something was 100, now it's 50. Okay, well, now it needs to go up 100% to get back to where it was. And over time, how that plays out is any portfolio that's less volatile will have better returns, all else equal, because you reduce that volatility drag, which again, you can do by increasing the number of holdings and the spread of diversification in your portfolio. And just simplistically saying, okay, if you have, 50% of your net worth in one company, well, if that one company's stock goes down 50%, that's a 25% hit to your overall portfolio. Whereas if that stock were, maybe down to 10% of your portfolio, a 50% drop would only reduce your net worth by 5%. So just a simplistic way of saying we think all else equal, odds are heavily in favor of diversifying if you want to optimize risk and reward for the long term.
So next, many people I feel like don't know this. Usually people think that, hey, by owning stocks, that means everything goes up eventually. But the reality is much different. Most stocks actually do really bad and they never recover. I think the stat from JP Morgan studying 13,000 stocks from the Russell 3000 from 1980 to 2014 found that 40% of stocks suffered a 70% decline from their peak and remained 60% below that peak at the time that this study was done. So a lot of stocks do very poorly. We've seen examples of this recently. Pick your poison. Thinking just back to the COVID pandemic, and Zoom and Peloton went crazy because everyone was working from home and that sort of thing. And now they are not the high flyers as they once were. Let's put it that way.
Yeah, those are definitely down 60 to 70% or more from, the COVID highs when everybody thought everybody would Zoom and Peloton forever. And the extreme scenario, obviously, for any given stock going down is literally any stock that goes to bankruptcy or the stock goes to zero. And as someone who covered the banking industry as an investor for a long time in my previous career, 3 examples from 2023 were sort of high flying regional banks that had put up, 15 to 20% annualized returns for long periods of time. And then all of a sudden, the concentration they had in their deposit bases became a concern and the stocks were worth nothing. So you can very quickly go from feeling really good about your stock, having done very well for a long period of time, to all of a sudden it's worth nothing and you lost your entire investment that you had in that stock. So yeah, the stats on how often stocks do very badly and even go to zero at least were surprising to me when I first saw them.
Yeah. And those were, what was that, First Republic and then Silicon Valley Bank?
Yes, and Signature Bank in New York. Exactly.
And then in history, you can just look back and say, hey, the big winners in the past are no longer the big winners. Thinking of GM, Sears, and Kodak. The Sears store that was the anchor tenant at the local mall here is now currently a pickleball court. So it has been completely transferred to a totally different line of business.
Yeah, there was another stat in that JP Morgan study, which looked at the Russell 3000 over that 34-year time period, that said they looked at the S&P 500 and how much the turnover is. And basically over that time period, you had about 10 companies out of the S&P 500 that were dropped out of the index due to financial distress. So it's like, wow, even companies that make it as big as being in the index, literally, what's 10 over 500? 2% per year just drop out due to financial distress. So every year you have big brand name companies that are doing badly enough to get dropped out and oftentimes go to zero. Similar to that JP Morgan study, there's a great academic study done by a professor at Arizona State, Hendrik Bessenbinder, who looked at the past 100 years of U.S. stock market returns. And over that 100-year period, the index is up 10% per year, which is pretty incredible. And the number of stocks, which was consistent with the JP Morgan study, that have outperformed the index over the lifetime of that stock is like 28 to 33%, depending on which study you look at. Best & Binder said 28%, JP Morgan said 33%. So basically, a minority of stocks are able to outperform the index over their entire horizon. And the Best & Binder study put it even more succinctly when he said, really, out of the 30,000 stocks that have existed in the U.S. over the past 100 years that drove that 10% annualized return for the market over that time period, only 46 out of the 30,000, so 0.15%, drove half of the overall dollar gains in the market over that 100-year period. So very small number of really big winners. Our thinking is for index funds, rather than trying to pick the needle out of the haystack, as Jack Bogle said from Vanguard, you just buy the haystack and you're much more likely to own the next wave of big winners who will drive the next leg of market appreciation over the next 30 to 100 years, which is how we think about the time horizon for us and our clients. And we think diversification through broad index funds really is the way to go.
So if you're listening to this and the takeaway isn't necessarily that concentrated stock is the worst thing in the world, that might be one of your takeaways after the data that we just shared. It's more of saying, hey, let's take a closer look at this and let's try to manage this because of these reasons. Moving forward, what are some ways to take some risk off the table because, it's not as diversified. It's very hard for these companies to continue their outperformance and so on and so forth. So building out a diversified indexed approach portfolio is what we think is best for folks for the long term, but that's hard to do with concentrated stock. And I think it's something for folks to consider and plan for. And we'll talk next time exactly how we do that. But hopefully this puts a little bird in your ear of thinking about maybe this should be something that we're looking to do is removing some of this concentrated position.
Yeah, I read a great book called Managing Concentrated Stock Wealth by a practitioner who's been around for a long time named Tim Kochis in the industry. And he said, in the simplest terms, suppose the concentrated stock promises a return of 30% per year, but only has a 20% chance of accomplishing it, while a diversified portfolio or a diversified alternative promises only a 9% annual return, but has a 90% probability of success. Well, that summarizes how we think about these situations, because the probability weighted odds of success are much higher using more diversified portfolios. And the downside scenario is much less severe as you improve diversification as well. So concentrated stock is something to work on and manage, which we'll talk about more in the next episode.
So there you go. Thank you so much for listening. Thank you to Kevin, our wonderful editor. We'll see you next time.
Like our perspective about wealth? You can explore our approach at birchwoodcapital.com. We work closely with high net worth families to manage their wealth and create thoughtful, customized plans and strategies. The information in this podcast is for general, informational, and educational purposes only. It should not be relied upon for any investment, financial, or any other professional advice. The opinions expressed by the hosts and guests are their own and do not necessarily reflect the views of any affiliated organizations. Investing in financial markets involves risk, including the loss of principal. Past performance is not indicative of future results. Consult with a qualified professional before making financial decisions. Thanks for listening.